our focus on clients are very much on those clients that are very synergistic with Bill Group being a wealth manager. So we like to focus on fund projects that have been initiated by IFAs, family offices, or wealth managers, for example, because these clients, they really much appreciate the value that a third-party manco can provide in infrastructure. Plus, they're not really price sensitive. I think, obviously, we look a lot at institutional asset manager. However, these guys, they don't see much value in what a third-party AIFM can offer.
We have a very strong German base of clients, and then also US base, which was developing quite quickly.
The long-term position will be there will be many managers, primarily in the US but also in Asia, who have no office in Europe, but have European investors, have no intention of getting an AIFM license, and they will need a solution to raise money, particularly after 2018, and funds like ours will provide that solution to them. We thought most of the business would be US, and we've been surprised by the amount of European business. And some of these people are people who were going to get an AIFM license and then had problems getting a license. Particularly people in London, we found now, who were applying, had a London office, were applying for an AIFM license. 18 months has gone by and they don't have a license. And the FCA is saying, hold on, where's your risk team? Where's your compliance team? And what they had is 2 deal makers and a secretary in London, and they thought they could get a license, and that isn't sufficient. So that people are then flipping back and saying, oh, okay, do we really want to do this? Do we want to add all these people under an office? And then they start saying, okay, let's take a third-party solution.
That's something you also mentioned. Sometimes we see also solution where the portfolio manager decides to become an AIFM, but they don't have the structure to do the risk management. I think you do perhaps that as well. And so, as AIFM, we act as the appointed risk management function. It's also a solution which helps, because sometimes people do not want to invest extra money in having a fully fledged risk management team, head of risk, assistant. So something we see.
Does it mean that finally your client base is more US, investing in Europe, but don't want to set up a European manco?
I think it's too early to say, but if you look at the global private equity business, global alternative asset space, the biggest space is in North America, in terms of size. So clearly there are more managers in North America, and they, insofar as that they're looking to raise money in Europe, one would expect naturally, that would be a large market.
So
sorry, but
it's a lot of parallel structures we see for the moment coming from the US. But as I said initially, our main client base is German clients. It's managers, it's insurance companies which have their own platform. It's pension fund money now coming to. So I think it's very diverse. And so it's not just, but it's the parallel setup is very US specific. So the European investors we have on our platform, they just set up a dedicated fund which is then distributed either to only European and others. It's for different reasons. What we said also initially is it's just to avoid regulation, so our clients want to stick to their core business, which is managing money, investing, identifying deals, and managing this kind of deals. So these are transaction guys, and they just want to be not confronted with all this administrative burden. On the other hand, there's also clients which have a regulation as a financial institution, a banking institution, or manager, but they don't want to create another setup as an AIFM, and they're quite happy then to use a third-party AIFM which provides all the necessary services. So we have all the services within LIS, for example also risk management, where we are differentiating ourselves, where we have 8 persons working in the risk management department. And what we see now is also from the investors in the fund, so mainly institutional investors, pension funds or insurance companies, so they need, in order to manage their global asset allocation, certain risk metrics or quantitative risk metrics to manage their allocation on a global level. So they have, of course, the majority in liquid assets, and where they have all the quantitative metrics like VAR, for example. So they also need this kind of metrics in the alternatives world, and that's what we are able to produce on real estate side and also on risk on private equity side. This risk management matrix, in order to provide these guys with this kind of service. And I think this is something also Luxembourg should build on in differentiating themselves. Always Luxembourg is mentioned as being just a pure back office world or country, and I think here is also that we move all up the value chain in providing different kind of services. Being a portfolio manager or allocating this intellectual portfolio management will be quite challenging for Luxembourg. I think around risk management, around valuation and distribution services, so I think this is also an important topic.
It's two things actually, about the model and about US. So first of all, you're right, the model is developing. It's quite a new model still for the alternatives, because for those of you who have worked with UCITS in the past, I think you have, Pierre perhaps as well. It's not a new model. It took some time to put it in place. I started to work with UCITS management companies in 2006, and gradually it's become a model which is understood. But we should perhaps, I think, a few years before, so 3-4 years before, when we started to speak about AIFM using the third-party model, that was really new. Many people didn't think that it would work. Now we see that Europeans are actually quite interested, and we see that it works. So I think perhaps US is coming to the same.
They're going for private placement into the UK, into the Netherlands, but they need a regulated vehicle or structure for other countries.
And of course 2018 is coming up.
That's a good point. Yeah.
And I think, I was at this roundtable organised by Real Deals. There were people there from Guernsey and Jersey saying, oh, this date will be postponed. But if you go to Brussels and you meet members of the European Parliament, they don't think it's going to be postponed. Their perception is, we pass these laws, we represent the people of Europe, we pass these laws, and actually we're quite upset that people are going around them. So actually, I think, is it politically popular at the moment to postpone that date? Which politician wants to be soft on the financial service industry? So our perception is that the date will not be postponed. And that after 2018, people will have to.
If your distribution strategy is focused, as you say, on the Netherlands or the UK, you can stick to the private placement. It's a simple notification process. That's fine. If you have a broader, distribution landscape, you have to do something, and you have to have a sustainable distribution strategy. And this one goes through, the creation of a co-investment structure in Europe. Obviously, we're preaching for Luxembourg and the appointment of a third-party AIFM. And I think that this trend will only grow bigger.
I think there's a real acceptance now for this kind of setup. So when we were speaking to the first US managers like 18 months or 24 months ago, it was okay, do I lose control? So then you have to explain to them, no, you set up and own the GP, and the GP appoints the third party, whoever third party is, and who says appoints can also revoke this guy, so you stay in control.
Yeah. And there also be another point, is I don't know how it was in all our structures, we don't control the bank accounts.
Yeah, I was going to say
exactly.
So basically they control the money.
Yeah, exactly.
So on one hand, the advisor says to you, I advise you to buy this building wherever, in Frankfurt, shall we say. And you check that it's consistent with the offering memorandum of the fund, and if it is, you say, yes, let's buy this. You then instruct the GP, which is the other hand of the same group, to actually do it. Yeah. And they then issue the capital calls and push the thing through. So in fact, we don't control the money. And if you don't control the money, I would argue you don't really control it.
Yeah, I think the model offers, flexibility, and it's easy to implement, right? I mean, the directive aims to regulate the manager, so it's simply about interposing a third-party AIFM in the fund structure. It's fairly straightforward, just the execution or having an AIFM agreement, and all of a sudden, magically, the fund structure is AIFM compliant.
It's important to understand the asset and the way it works. I think one of the points is also that you can certainly, it's important not to disrupt the process that is already in place.
Many of the concern we hear from clients is that, yeah, okay, maybe you're disruptive or intrusive in the business model, and what comfort do I have that you guys will accept the investment recommendation, right? I think, you know, the model has been evolving, and as far as BMI is concerned, we have the ManCo with portfolio manager, pretty much like you guys do. So we speak the same language, and that really smoothed out the collaboration, right? So we speak the same language, and the collaboration is fantastic. And for our counsel not to be unreasonably withheld, I would say, we just make sure that all the risk factors, as described in the investment memorandum or customary for any type of transaction, are properly addressed through specific report, due diligence report, or whatever.
What's the view of the investor for the third-party AIFM ManCo? Do you? I understand for the fund promoter's interest, but for the point of view of the investor, do they look at the third-party ManCo? Do they have due diligence on you? Because for me, an investor selects a team, and so if the team delegates the portfolio management or the risk management to a third party, for me it's critical. So I presume that investor will look at you.
There was a due diligence which was done on the whole platform, not only on the manager, so the third party, also on the administrator, the advisor/manager team, the depository bank, and this third party is just an element of it. And so if they feel comfortable with the whole setup, being it now an external third party AIFM or the manager having it internalized, doesn't make a difference for the investor. So what he wants is really having a solid platform in which he invests, and I think the other point is also that he also will look into the cost structure and see if I add everything up, how much do I pay? So having these different service providers working together, but we had a couple of these due diligence from larger investors who have done it so, and there was never an issue that the manager or the investor, the fund promoter, had outsourced the management company to a third party manager.
Yeah.
I think Pierre made a very good point there, and that's, in most cases we're just an element of the whole thing.
Yeah.
But turning on its head, it's actually investor driven, and you may have a very exciting fund which a German or French insurance company would like to invest in, and actually if this structure is not put in place, they cannot invest. So it's actually round the other way.
Yeah, exactly.
If there's not a third-party AIFM, there's no way that they can invest in that particular fund. They're excluded from it because of FMD.
You see a lot of parallel funds, so yes, promoters with parallel fund co-invested with Fidelity or whatever fund, and they have to set it up within, I'm saying now, 2 months' time. And now applying for their own license would take ages, and they don't want anyway to do it. So then they use the third party, and then the big investors, so they're setting it up for 2 or 3 investors, investing like I'm saying between 100 and 200 million,
Correct.
And they are fine with it.
With the portfolio management comes the investment decision, right? And with the investment decision come lots of responsibilities and potential liabilities if things turn sour.
That's why we're obliged to take out a lot of insurance under AIFM.
As well, but that's the last resort. But I mean, I see a lot of people who have more of a depository line, tick the box approach and position themselves as a mere regulatory pass through. Accepting and validating the investment recommendation. As far as we're concerned, we don't take our role lightly, I would say. We don't take it from an administrative perspective, and we make sure that we're involved in every single step of the investment process.
Particularly after 2018, when we're mainly doing infrastructure and real estate funds, those funds traditionally have always been externally valued. Particularly real estate's always been externally valued. So appointing a Duff and Phelps or an Unlocky or whoever to do the valuation is standard, and managers expect that. But most buyout funds have done their own valuations historically. And most buyout funds are still going around the rules. I mean, a few may have done structures here, but most are still going around the rules. After 2018, they will have a problem. And then it's going to be very interesting what happens on the valuation side, because if we're really expected to do valuations and hire a bunch of valuers, which you could do, then I think there's a question of what you charge for that, because there's a huge amount of liability attached to it. Whereas if you exhaust it, of course, you effectively, yes, you're liable, but you can always effectively blame. And if you've hired one of the big global valuers and then it's audited by one of the big four, an investor, an LP, to actually sue you and say it was a false valuation, they've got a very high barrier in court to come up to it. The lawyers would advise them never to do that. But if you've just done the valuation, then it's or the GP does the valuation and expects you to rubber stamp it, then I think that's a real problem. But it hasn't so much happened because a lot of the business has been real estate or real estate debt or infrastructure based.
Yeah.
And that business, people typically used external valuers.
You decided to move to
Yeah, well, we
Perhaps you
moved.
should tell us, why did you come to
Well, originally we were a private equity firm based in the Cayman Islands, like lots of other private equity firms, and we had very little substance. And AIFMD came along, and for me, it was Commissioner Barnier's statement after AIFMD was passed by the European Parliament in November 2010. It was passed on a Thursday. On Monday, the European Venture Capital Association, they're now called Invest Europe, gave this flash conference in Brussels in which he spoke. And what he said is, it was a brilliant piece of politics. I mean, whether you agree with him or not is different, but the speech was very well written, very well put together. And he basically said, in the cradle of capitalism in America, you can't run a private equity firm or a hedge fund without being registered with the SEC. It's illegal. And we should learn from our American cousins and put a structure in place in Europe, because the assets that these funds run potentially provide a systemic risk to the European economy, to the EU economy. And most US funds are based in Delaware, which is a US state, and most funds that invest in Europe are actually based in islands between Britain and France or in the Caribbean, and that's literally what he said. And he said, we're going to change this, and we're going to bring this business onshore into Europe, and these measures are designed to do that, and if they don't work, we will take further steps to bring the industry onshore, so the people of Europe have a sight over what's happening. So we came out of the room and we said, well, no one had thought about third-party mancos, I think, for private equity. Maybe you geniuses had thought about it in 2010. But we said to ourselves, we need a license. We said, well, logically, we should do it in Luxembourg. And that's why we came here. And then when the third-party solution came up as an idea, we saw that really, you can't really do this from many other places. Here you have the government committed to AIFMD being a success here. You have no VAT on management fees, which is a very important point. And you have, I think was also very important, you have a limited partnership structure, the special limited partnership, which is totally analogous to a Delaware or a Guernsey or a Cayman or a Jersey partnership. So you can create parallel funds with exactly the same documents, they're mirrors.
And also a regulator which is used to third-party
Yes.
bankers. And service providers who are used to work with third-party
And you have a
bankers.
pool of employees. I mean, this is a financial service cluster where you can hire staff with the skills to make it work.
I would also add to this, and this goes back to 2007, the SIF law was voted and incorporated. So here in Luxembourg you have an experience now for almost 10 years of real estate and private equity being packaged into an SIF structure. So at this point of time, the SCSP, so the new limited partnership, was not available yet. But nevertheless, I think Luxembourg started to promote, sell, place its products within institutional investors in Europe mainly. So Luxembourg was already known, the products of Luxembourg are already known. And I think what I see is really the acceptance by investors of Luxembourg-based AIF. So that's also one of the main advantages. So the German insurance fund or the French one, they don't have to do now a new due deal on an UK or whatever Irish structure. So I'm saying that they are probably as good as Luxembourg ones. I'm not now in detail, but the difference is Luxembourg is known from the UCITS world, is known from the SIF world, and now let's continue with Luxembourg, and then as a product it's accepted, and then we have all the other advantages as I just mentioned. I think the combination of these different factors really make Luxembourg an interesting place to launch your AIF, and then using a third-party AIFM if you don't want to implement your own substance. So that's
No, absolutely.